Welcome back to the Till. Today we're going to get into what are interest rates going to do next week, next month, next year. 7 financial pros weighed in on it today. Let's get into it. Let's talk about it, and then I'm going to give you my prediction of what rates will do and why. We'll see who's right in the near future. Here's the thing, most forecasters think rates are going to stay the same, flat, or slightly lower through the end of 2026. Stephen Cates from Bankrate thinks mortgage rates will remain stable through 2026, sitting between 6 and 6.25%, basically where they are at right now. His key insight is the Federal Reserve rate cuts don't directly move rates. It's all about the labor market and inflation data. Kate Wood from NerdWallet predicts we might see a small dip in December if the Fed actually cuts rates, and also depends on the November jobs report, which technically doesn't come out until like 10 days after the Fed meeting, I think on December 16th. Jeff Durgan, the economist at Loan Depot, is forecasting rates will stabilize between 6.15 and 6.25 through December and into next year. And housing activity might get a small boost because rates are near their low over the recent last 2 or 3 years. So let's have some real talk about why I think, or what I think interest rates are going to do. I do think the Fed is going to cut next week. Rates are usually their lowest the week before the Fed meeting in anticipation of what the Fed's going to do. But what's next? I'm going to get into a few topics of what I think is going to happen next year. First and foremost, I'm most worried about all the talk about the CapEx spending by the Mag 7s. All these big corporations are talking about billions of dollars coming back into the States because of tariffs and the spending on AI. Trump tax laws are in their favor to write off that CapEx spending. The faster they can build it, the faster they, under these new rules, they can write it off and then reap the rewards. You never know what the next administration's going to do, right? So I do feel normally when people in corporations say, I'm going to spend all this money, you normally don't always see it or think it's going to happen. I think it's going to happen because it's to their advantage and to their advantage to their bottom line. That's item number one. Item number two, over my career, interest rates are typically cyclical. They typically go up and down on a 2-year basis in normal markets. Granted, we had a period of time during COVID, it wasn't normal, but I feel that we've had downward pressure for about the last 14 months, and I think we're about 14 months into a 2-year cycle. So I think we're going to get that Fed cut in December, and then it's going to be a wait and see type of thing, and then we're going to hit the March market. Over my 29-year career, typically rates go up in March, come down in October through March, they kind of trickle down, and I have a lot of refis during that time, a lot of no-cost refis, until the spring market comes back, supply and demand, and then rates go up. Third reason is a big one. Gas prices. Normally when gas prices are higher, it puts pressure on Wall Street and the consumer that they're not spending as much money, and typically that's downward pressure on interest rates. Since Trump's been in office, gas prices have gone down. So while he wants lower rates, there's no guarantee that the catalyst of having lower gas prices puts more money in the wallet, and that's inflationary. So we have inflationary from corporate. We have inflationary from the consumer having more money in their pocket. All of these things are items to which, when we get a new Fed chairman next year, what position is he going to be in? If he pays attention to his dual mandate, it's all going to be based upon unemployment at that point and inflation, which is their two mandates. If the AI cap spending actually produces higher job efficiencies, that could keep unemployment down, and there will be some cover for him to maybe lower interest rates. But again, that's only if we don't have layoffs because of AI. So I feel there are two pressures. The consumer's doing a little bit better with the gas prices coming down. If the real interest rates come down, people save a little bit on their credit cards, things of that nature. I feel it's going to be a wait and see mode and could be at the end of our 2-year cycle, and rates could actually be higher at the end of next year than they are today. We'll see how my prediction pans out. My name's Kevin Retcher, owner of First Meridian Mortgage. If you've bought a house in the last 3 years, you should look at potentially doing a no-cost refi today and or before March, in my humble opinion. Talk to you soon.